Hi everyone, welcome to part 1 of the Great Depression. Our questions to think about: what were the causes of the Great Depression? And how was the stock market crash an indirect cause of the Great Depression? When we take a look at the causes of the Great Depression, much of this is related to the unstable foundations of the 1920s economy. In a lot of ways, the economy of the 1920s reminds me of the Gilded Age, that on the surface, everything looks shiny and pretty, but underneath, we have serious problems that are being ignored. So the economy of the 1920s boomed, but that prosperity was a facade. The basic explanation for the Great Depression lies in the fact that U.S. factories produced more goods than the American people could consume. Each year after 1924, the rate of increase in the sale of cars and refrigerators and ranges slowed, a natural consequence as more and more people already owned these durable goods. There's also an issue of an unequal distribution of wealth. The problem was not that the market for such products was fully saturated. In 1929, there were still millions of Americans who did not own cars or radios or refrigerators, but many of them could not afford the new products. The new economic system had failed to distribute wealth more broadly. Too much money had gone into profits, dividends, and industrial expansion, and not enough had gone into the hands of the workers, who were also consumers. Factory productivity had increased 43% during the decade, but the wages of industrial workers had gone up only 11%. So if the billions that had gone into the stock market speculation had been used instead to increase wages, which would have then increased consumer purchasing power, production and consumption could have been brought into balance. So I want to repeat this for just 1 second. Durable goods are goods that are meant to last 3 years or more. So think about your washing machine or your refrigerator. These are things that you expect to own for many years. And durable goods can be an indicator of sort of economic optimism or pessimism on the part of the consumer. So let's say that your washing machine is 8 years old and it functions just fine, but you just got a big raise and you're really optimistic about the future in the company. So why not take this time now when you have the money to replace your washing machine before something really goes wrong with it? On the flip side of that, if you're really pessimistic about your company, maybe they've had a wave of layoffs, maybe it's time to baby that washing machine a little bit, and hopefully it'll last you for a couple more years. So that is the way in which durable goods are economic indicators. Now, the problem here as we approach the end of the 1920s is that durable goods sales was flattening, and factories did not decrease their production. But the problem really wasn't necessarily a saturated market, but rather there were lots of people in America who didn't own these things, but they didn't because they couldn't afford it. Many of the companies and corporations had spent so much energy putting their profits into the stock market, into the hands of their investors, and very little in the hands of their workers. One of the things we're going to repeat later on is the idea that consumer spending drives the economy. And if we don't get money into the hands of the factory workers, then they won't be able to buy things. The other thing that's going on here is that we normally would sell our overproduced goods to other countries, but with Europe still really suffering from the end of the Great War, Europeans simply don't have the money to buy American-made products. Germany in particular has been hard hit by the reparations of the Treaty of Versailles, and Germany is experiencing hyperinflation to the tune of about 1,500% per year. So to put that in perspective, something that costs you $1 today, next year would cost you $1,500. There are still more causes of the Great Depression, these foundational issues. For many people living in the East, the plight of the farmer was less noticeable. But as European farmers recovered from the Great War, the demand for U.S. farm products decreased rapidly throughout the 1920s. And by the time the drought of the 1930s hit, farmers were already on the verge of losing their farms if they had not done so already. So it should have been a warning that the agricultural sector had been declining since the end of the Great War. Another issue is excessive credit. It all comes down to the fact that people did not have enough money to buy the consumer goods coming off the assembly line. So they used the new strategies like installment plans, which is basically like a layaway plan. You put a little money down and you pay for it over time, except in this case, you get to keep the product. And putting things on credit doesn't really seem like a bad thing during good economic times. I mean, if you think about it, you're going to pay $1 a week for your radio or $5 a week for your car. And all of that is manageable until you lose your paycheck. And then all of a sudden, it's overwhelming. And that's what happened to a lot of Americans here throughout the 1920s. Another issue that we have here are government policies. Republicans are going to take credit for the booming economy of the 1920s, and the booming economy ensures that Republicans will be victorious on Election Day throughout the decade. Specifically, the deal with government policies that very much favor businesses. So specifically, Andrew Mellon, who was President Harding's Secretary of the Treasury, was a wealthy Pittsburgh banker and industrialist, and he's the one who leads the charge for trickle-down economics. So if we look into an economics textbook, you might find the definition of supply-side economics or trickle-down economics as economic growth that can be most effectively created by investing in capital and by lowering barriers on production of goods and services. And what that really means is you free up money for the wealthiest and for corporations. So one of the ways that Congress can do this is through a major tax cut. If you give the wealthiest Americans a tax cut, then the idea is they will use that savings and that money to invest in new businesses or to expand their factories. And then they'll hire more workers. Those workers get a paycheck, and then they're going to spend that paycheck on things. So consumer spending drives the economy. But this is really a top-down method for stimulating the economy. So Congress does just that. They lowered the maximum income tax rates for the wealthiest from 65% to 50%. And then by 1926, it was reduced again to 20%. But the problem was that the wealthy did not invest in their businesses, and instead they used their excess cash to begin investing heavily in the stock market. And they were betting that the already impressive rise in the markets would bring them even greater profit. So here's the deal with trickle-down economics. We've tried this a couple of times throughout our history. Here in the 1920s, in the 1980s, we're going to refer to it as Reaganomics. And even today, in the 21st century, the current president, Donald Trump, is really looking at stimulating the economy from the top down. And historically speaking, this has been ineffective because the wealthiest have not done what the strategy proposes they do. And here in the 1920s, they took that extra money, that freed up money, and invested in the stock market. Speculation in the stock market refers to the rapid buying and selling of stocks in a bull market in an effort to take advantage of the steadily increasing prices. So a bull market is a market that is increasing, and a bear market is a market that is decreasing. So it's interesting to note that speculation creates a bit of an inconsistency or an inaccuracy in the value of a company's stock, with a lot of people buying and selling, trying to take advantage of the little dips and rises in the market. You are unnaturally inflating the price of those stock. So typically, the price of a stock is supposed to be a representation of the value of the company. But when you have widespread speculation, it's like it's creating a bubble. And that's a term we sometimes hear on the news, that the stock prices have been inflated. And a market correction is a situation where those prices come back down to reality. Now, the problem for a lot of investors is they're going to take a huge financial hit when that bubble bursts. But it's not just the wealthy who were investing heavily in the stock market. Other people were trying to game the system to make as much money as possible. The strongest surge in the stock market began in the spring of 1928, when investors began to ignore the declining production figures in the belief that they could still make a killing in the market. So what we see is this dramatic increase in the value of stocks. So in 1925, the whole value of the stock market was about $27 billion. And just 4 years later, in 1929, it was $67 billion. In addition to speculation, buying on margin was a big concern. Buying on margin is buying stocks with borrowed money. Investors could play the market on credit, buying stocks for as little as 10% down. And in the bull market climate of the 1920s, everyone was sure that the market would go up. Investors borrowed money from brokers who sometimes received money from corporations. Corporations, and again, instead of expanding their production or paying their workers more, are taking these huge cash reserves and giving it or loaning it to stockbrokers, who are then going to loan it to investors on margin. And of course, what do you think the stockbroker is going to recommend his customers buy? Whatever corporation loaned him the money. For example, in 1929, the Standard Oil Company loaned out $69 million a day in this fashion. And then, just to make the situation a little scarier, investors sometimes borrowed money from banks to buy stocks on margin. By 1927, the consumer demand for goods had begun to drop, and this is spurred by decreases in consumer demand. Production and employment declined by mid-1929, but neither businesses nor government leaders were heeding the warnings. When people looked out at the stock market and this massive bull market, they were convinced that the economic forecast was healthy and prosperous. So Americans were making the mistake that a bull market was a healthy economy. And it's important to recognize this is a misconception. Even today, in our crazy coronavirus times, people are misunderstanding the rising stock market for a healthy economy. If we look around our world today and we look at the number of people who are unemployed, this is not a healthy situation. So it's not quite making sense why the stock market is going up. We have a similar situation here in the 1920s. When the stock market soared to more than $80 billion in total value by midsummer 1929, the Wall Street Journal discounted any possibility of a decline. They said, quote, "The outlook for the fall months seems brighter than at any time." So the Wall Street Journal is a credible financial journal, and they are completely missing the boat on these economic indicators that are saying the economy is in decline. The change comes very suddenly. On October 24th, 1929, later known as Black Thursday, the rise in stock prices faltered, and when it did, nervous investors began to sell. Leading stocks such as RCA and Westinghouse lost nearly half of their value in one day. The stocks fell an average of 37%, but the crash is officially noted on October 29th, 1929, or so-called Black Tuesday. Speculators panicked as their creditors demanded new collateral, and the panic caused prices to plummet further. It's important to remember that the great stock market crash of 1929 is an indirect cause of the Great Depression. Notice the chart on the upper left. If the foundations of the 1920s economy had been solid, the impact would have been relatively mild. But because of speculation and buying on margin, the great crash of the stock market spilled over into the larger economy. I really want to draw your attention to where Black Tuesday is on this graph. It is not the bottom. The market low doesn't come until 1932. If we were to draw a line where Black Tuesday was, it's a market correction. All of that top peak of the iceberg is speculation. It's inflation. It's a bubble. But because the foundations of the 1920s economy were unstable, the stock market crash is sort of like bumping the table during a game of Jenga. It starts the whole thing wobbling and it's about to crash to the ground, especially the impact on banks. I've got a political cartoon in the upper right, and it's got a little squirrel here talking to a man who appears to be homeless and is a victim of bank failure. The squirrel asks him, "But why didn't you save some money for the future when times were good?" And the man replies, "I did. But when speculation and buying on margin impacts the banking sector, then people begin to lose their life savings." Banks and other financial institutions had suffered heavy losses, and these institutions were forced to limit lending for consumer purchases, which leads to a downward spiral. As consumers have less money, factories are going to cut back their production and lay off workers or reduce hours for their workers. And then the layoffs and cutbacks are lowering consumers' purchasing power even further. So fewer people bought cars and appliances. And so more factories laid off their workers as a result. And this downward spiral is going to continue for the next 4 years. At the height of the Great Depression, the unemployment rate was 25% nationwide. And in some industrial cities, it was as high as 80%. So 80% of Americans in those cities didn't have a job. So coming back to our questions to think about, what were the causes of the Great Depression? It's not necessarily what you'd think it would be. It's actually the unstable foundations of the 1920s economy that lead to the Great Depression. So overproduction, the unequal distribution of wealth, the unstable economic conditions in Europe, the decline of the agricultural sector, excessive credit, and government policies, specifically trickle-down economics. And then how is the stock market crash an indirect cause of the Great Depression? The Great Stock Market Crash of October 1929 is really a market correction. It got the stock prices back down to where they really should have been. But because of the unstable foundations of the 1920s economy, specifically the unsafe business practices or bank practices of loaning money to stock speculators, leads to a crash within the financial sector. So the banking sector collapses, people lose their savings, and they don't have the money to buy new things. So we're going to continue this story with part 2 of the Great Depression.